So ACCR has done some modelling recently on the biggest Australian oil and gas company called Woodside. And what we have found from a fundamental value perspective is that there is a pathway for them that is value accretive with no emissions growth and lower risk. And that is that they just stop investing in the growth portfolio that they've set out and they return that capital to shareholders. Now, their current strategy is growth, growth, growth. That's what they plan to do. It's totally misaligned with a safe climate. How would NBIM view those kind of strategies? This is a nice hypothetical because I know NBIM does not hold Woodside because it's pure play. But, you know, is that something that's on the table for you when you're looking at companies in your portfolio?
Yeah, it's always nice to have hypothetical questions. But if a company tells us that we can make you more money by shutting down our business, then that's great. Yeah, as long as that's done in a way that takes into all
disorderly. Yeah.
Yeah, it's not disorderly, and that's perfectly fine.
I have a question for you that is not hypothetical. You have companies in your portfolio that are not pure plays. I'm thinking of one in particular. It's an oil major that passes the test because it is investing heavily in renewables. However, it has also very explicitly stated that it is not going to limit its growth in fossil fuels. It is going to grow as much as it can, particularly in gas, because why not? It's profitable, and as long as it's profitable, as long as there's demand, it does not subscribe to those those precepts that are being issued by the International Energy Agency, IPCC, and so forth. So, then what?
In our new expectations that came out on Friday, we are to backtrack. I mean, there's a huge discussion: what drives change? Is it constraining supply or constraining demand? What we're saying is that companies should set Scope 3 emissions targets for aiming for net zero, right? So I think that tells you something about the business model shift that needs to happen. Then we're also saying that for companies with fossil fuel demand, they should consider expected demand change and climate science. What does that mean? Well, that's opening up a discussion with the companies, because what is expected demand going to be, right? I think that is at least, there's going to be a very different perspectives on that. But just telling the companies, at least tell us what demand you're expecting, tell us the assumptions, and tell us how you think this is aligned with climate science, is sort of putting the onus on them to explain to us their business strategy.
Karina, to throw it back to you. So say you're the director of this company that is pursuing renewables investment and also pursuing emissions growth. What kind of strategies do you think would be effective coming from, say, John? in what's going to effectively, what's going to actually make you as a company director change?
Okay. So you've alluded to it by saying we would invite the company to explain to us their reasoning, and their reasoning can only be grounded in a view that demand will continue to grow. Whereas in Eni, we took the view that demand was going to peak. It was going to peak in oil sometime in the first half of the 2030s, and it was going to peak in gas sometime in the second half of the 2030s. And therefore, it made every sense economically, strategically, for the company to bet on that dip in demand. It also said that even if it doesn't, we are scientists. The CEO is a physicist, a substantial proportion of the staff are scientifically trained, and we accept the science, so that even if others disbelieve those projections, such as what recently came out by the IEA about demand peaking, and obviously there's a huge amount of debate about that, we subscribe to that view. This company does not, and nor do the Americans. And so what I would do as a director, or what I would do as an investor, is to challenge their assessment of demand, because it is a judgment call. And if you get it wrong, I mean, are you stress testing your model? In other words, as we did in Eni, at my urging, because I chaired the Sustainability and Scenarios Committee, and I said from day one, are we stress testing our model against a 1.5 degree scenario? Because we, as of 2014, we did not believe that a 1.5 degree scenario would happen. And then as we moved forward in time, we took the view that if it didn't, it should, and therefore we should be resilient in the face of a 1.5 degree scenario. So now, Eni routinely stress tests its portfolio against a 1.5 degree scenario, including by when it does its annual impairment review. It checks the headroom that is available, but in other words, the difference between book value and present value of future cash flows. And in the event that that headroom goes into the red in a 1.5 degree scenario, it has a commitment to adjust that so that it is resilient in a 1.5 degree world. And that's what I think investors should be demanding.
Yeah, and that, so, oh, you want to jump in,
Yeah,
John?
let me jump in on that. So what you didn't say
Yeah.
was vote against the director
Yeah.
or vote shares. I mean, sell portion of your book. So let me kind of loop back because, and this goes to some of our prep calls, which is that conversation, which is to challenge the board in that scenario on demand assumptions. Did you ever have that conversation, like in a high quality construct? Because I think one of the challenges that many of us have with engagement is that holy grail conversation is elusive. It can happen in hyper structured ways.
Yeah.
What tends to happen, at least for us, is its lowest common denominator, right? It's like, go get an SBTI aligned, but it isn't a high quality with, and also a lot of times we actually don't know. I would say we don't know that company well enough to make the call demand in their market and can't keep up. So anyway, so did you ever have that call?
So as it happens in the case of Eni, because it is impossible for you guys to vote us out. I mean, you can only vote us out once every 3 years, right? We're not up for annual election and we're up for election as a slate. So you can vote against all of us or none of us. So we were very insulated from that type of action. In other markets, I think it is immensely effective. So I think voting against directors, even if it's 5 or 10%, is such a slap in the face for directors. No director wants that. No director wants to have a significant vote against them. So the converse argument to that is, we need to have this discussion, guys, because investors are going to vote against us. If we don't demonstrate that we've had the discussion and that we've undertaken the stress test and that we can report transparently that in a 1.5 degree aligned world, our portfolio is resistant. You need to be able to say that. And I guarantee you most of the companies are not, based on, I can see what they're doing. And we in Eni would benchmark ourselves against all our peers and we would think, they're not 1.5 degree aligned. So that's one. Divestment is an interesting one. Obviously, for example, we know that in the case of the Exxon vote, there had been so much divestment that the types of investors who would have supported the nomination of all 4 of those candidates, many of them had gone by then. So they only got 3 out of 4 over the line. So your impact is diminished if you have sold. On the other hand, companies live in fear of divestment. They really do. The number of times I have heard in my boardroom, the CEO, the CFO, IR talk about how we are facing headwinds, how, our PE ratio is lower than, our electricity business. We're actually in the process of spinning out our electricity business, 10, 20 or 25%. We'll still have control, but just to boost our valuation because the electricity business has a much, much higher rating. It's just much better appreciated by the market than the oil and gas business. So that stuff really weighs on boards. And that is caused by the fact that investors are losing faith in the industry. And sometimes it's motivated by an ESG sort of, I'm anti-oil and gas. And in other cases, it's just a cold, hard look at the fact that it's a risky business and the risk return ratio is turning against the industry.